Well, some oil marketing companies have begun reviewing prices at the pumps. They were expected to do so over the weekend. But today we are seeing that materialize. Kwawu has taken the lead, selling a litre of petrol at 12 cedis 65 pesos, diesel going for 12 cedis 84 pesos. Also, Star Oil selling a litre of petrol at 11 cedis 69 pesos, whilst diesel going for 12 cedis 69 pesos a litre. Now, the adjustment shows that petrol has gone down a little over 2%, whilst diesel has been reviewed by almost 5%. It is expected that more OMCs would adjust prices at the pumps downwards later today. Oil prices have surged after several of the world's largest exporters announced the price cuts in production. That's the other twist to this story. The price of Brent crude trading above $84 a barrel after jumping by more than 5%. The increase came after Saudi Arabia, Iraq, and several Gulf states said on Sunday they were cutting output by more than 1 million barrels of oil a day. So question now, are we going to see the reductions we are seeing in Ghana here sustained as oil prices are beginning to surge on the global markets? Joining us on Zoom, Dr. Yusuf Sulemana, who is an energy expert, to delve into this matter. Good afternoon to you. Thanks for joining us. So explain to us what is happening on the international markets, for which reason oil prices are beginning to soar.
Thank you very much. Good afternoon to you, Daryl, and good afternoon to the viewers. Yes, indeed, it came as a huge surprise to the market. Nobody expected OPEC to take this step at this moment in time, because if you look at the fundamentals, what should have urged OPEC to take that step would have been a weakening in demand. And if you look at the demand side of the continuum, you will realize that it's still robust. The single player or the single international player that is key for global oil demand is China. And if you remember, China had abandoned the zero policy of COVID. And so the expectation was that, in fact, demand was supposed to have increased. So all fundamentals were right. Demand was still very strong and resilient. So, but if you look at why OPEC did that, if you notice over last week, something happened in the financial market that was just out of blue. A bearish sentiment reigned into the market where we had phenomenal collapse of some banks, and that cascaded into a potential, a demand drop, not physical demand drop, but a potential demand drop. And so you remember that deep oil prices to the 70s. And so, but after that, it has started to recover. So I'm just thinking that OPEC is just taking abundant caution because they have enjoyed this 80 barrels of oil per stream, per barrel within the market for the last 6 months. For the last quarter of last year, it's been 80s, and even up to the first quarter of this year, it's also been 80s. So I suspected that OPEC would have taken this step, and so they did what they want to do is just to bring the oil back to the 80s, because they felt the 80s should be the comfortable zone for them. If you notice that, where it dropped, from where it dropped as a result of the banking crisis to the 70s, right, I don't read the oil was around 85, 86 when it dropped to the 70s. So I think they just wanted to trick the market. But of course, this is not a physical reduction in demand, in crude oil into the production basket. What we are seeing now is just as a result of sentiment. And of course, these bullish sentiments will always have impacts on the market. So as it grows like this, we need to just watch out to see where it will settle. But it's actually unfortunate because we already had a supply card in place. This is not the only one. In fact, before this one, we had about 2.5 million, crude oil barrels of oil per stream day already cut by OPEC. So if you add this one and it crystallizes into the physical reduction in demand, in supply into the market, we'll have like over 3.5, 3.6 million of crude oil taken from the global basket. And that will mean that we are taking about 3 to 4% of the entire, what the global demand from the market. So yes, that will certainly have an impact in the market. So I'm not surprised that the market jumped instantly after this announcement.
Well, we're just beginning to embrace the idea of fuel prices declining here at the pumps. And so now we are seeing oil prices go up on the global markets. What are the implications of this on pricing locally?
Yeah, so it's unfortunate, but if this drop, this rise actually sustained, we're going to have a bit of heat at the pumps. But fortunately, at this moment in time, if you notice previously, the dynamics has changed a little bit. Three things will actually account for what the consumer pays. Of course, you have the exchange rate dynamics that comes to play, the crude oil prices on one part, and then the taxes. Holding the taxes constant, I think at this moment in time, the exchange rate has been phenomenal. I must say so. We haven't had that major increment. We haven't had that. In fact, if anything, we could potentially have appreciation in the exchange rate in terms of the cedi to dollar parity. So if the exchange rate actually sustains this momentum and it doesn't drop, then this increase in the global front may not have that significant rise at the pumps. But what it will definitely do is what we're expecting, the quantum dip or the quantum reduction that we're expecting at the pumps at this moment in time, it will reduce. If it is not sustained where it is, it will definitely, the reduction will be reduced. The reduction will not be that massive like we have been expecting it. In fact, if oil prices were around the 70s, I had projected that if after the banking crisis, the oil price dropped to the 70s, I was just expecting that we could hit a single digit. Unfortunately, it didn't go there. The confidence has returned to the market. The banking crisis, of course, the oil has started to recover, and now all out of blue, we are seeing this. So yes, we will have some bit of impact on the pump, but it's not going to be as drastic as the previous impact that we had because of the stability of the currency.
Well, I guess this is also a test for the Good for Oil program because initially we've heard the government say, well, the fuel prices are dropping because of the Good for Oil program. And so if prices on the international market go up, I guess then we're going to see the real impact of the Good for Oil program. Isn't that the case?
Good one, Daryl. When it dropped, actually, you noticed that there were a lot of confusion as to what is accountable for this drop, whether good for oil was what is accountable or not. So indeed, as much as this is not a good one, but it brings a lot of clarity. If it sustains, if oil actually sustains within the 80s, then it brings a lot of clarity that whatever is causing the price to drop and the price actually dropping, then nobody will have any confrontation or any argument or any doubt with respect to what is causing the drop. Yeah, so yes, indeed, it's not good, but assuming now we still have the prices dropping, and indeed, if good for oil should have impact on the exchange rate, at this moment, it is difficult to tell because a lot of parameters are coming to cause this exchange rate to be stable. We can't rule out good for oil as a matter of fact for sure. It will also be part because, the pressure on the dollar would have been minimized for sure. But because of this, because these factors are aggregated, it is difficult to see which one is having the massive impact and to what percentage. So yes, indeed, if the oil sustains at this moment in time, and it will bring clarity, like rightly painted, whatever is causing the drop or whatever is causing the sustain in the rise at the pumps. But what is clear is that we were going to have a double gain in the sense that if oil prices within the global space were actually competitive, we're actually down in the 70s, and the exchange rate also being stable, then I was very sure that we could gravitate towards a single digit. But as of now, as the oil price started to go up, we might lose track on that aspect of it, the commodity price impact on the price build-up. But we need to wait, Daryl. This is just an instantaneous. It's just the market response. What we are seeing now is not a physical reduction in OPEC physical reduction from the market. It is just a sentimental response for the market with respect to the market, and that is normal in commodity market. So what we like to see is that getting to the mid of the week, you might see a drop or increase from this figure. This figure will not stay as this. You might see a drop. We hope there will be a drop and it will settle. But what is clear in the minds of OPEC is that they want oil prices above 80, and so that's how come they announce this. And they actually successful in getting the oil price above the 80s.
All right, Dr. Isi Sulemana, energy strategist, I appreciate your time with us and the insight that you have given us. Let's turn to the money market now. Interest rates rose marginally on the treasury market as government secured more than 21% oversubscription of the treasury bills. Now, the increase in interest rates is linked to the policy rate hike that we saw last week of 29.5% by the Bank of Ghana. Head of trading at Republic Securities, Patrick Edemagama, joins us with more on this. And before we talk about last Friday and the outcome of the auction, I want us to go back to a couple of weeks ago where we saw Treasury bill sale undersubscribed by 23.83% to the tune of 2.44 billion cedis. That was quite concerning. What happened?
Well, good afternoon, Daryl, and good afternoon to everyone. So, yeah, we saw the target for that week being 3.2 billion. In cases where the target is very high, you expect investors to not be able to meet that target for the government. Also, that same week, there were auctions for the BOG bill, so that actually took some of the bids instead of going for the treasury bill.
And so we have a different story this week. Interest rates rising following the policy rate hike, and government securing 21% subscription of T-bills. Give us a rundown of how the auction went last Friday.
Okay, so with regards to the auction last Friday, we saw that the target was 1.3 billion, but the government raised about 1.6 billion. The 91-day jumped by 15.96 basis points to close at 19.39. The 182-day saw about 41.77 basis point jump, also to close at 21.86. Again, the 91-day took greater chunk of the bids as it took about 77.8% compared to the 22.2% for the 182-day. We can also see that the interest rate for bids allotted range from 18 to 20% for the 91-day, and then from 20.38% to 23% for the 182-day.
So can we say it's back to normal? We've recovered from what happened a couple of weeks ago?
Not really. As interest rate is rising, definitely investors' appetite will be increasing, but the government will also try as much as possible to push the rates down. It is the balance of these two that will determine what the rates will be. In cases where the targets are low, they have the possibility to be able to push the rates down. But when the rate targets close to 3 billion and 4 billion, then you see that gives investors a chance to be able to also push the rates up.
So we've got one of our viewers who sent a question asking, do you think it's safe to buy T-bills now for the 91-day period, or do you answer to that?
Well, looking at the options we have in the market now and what the government said about T-bills not being affected by the data exchange program, that might be relatively the better or the best option for now. But obviously, the investor should look at their investment objective to see if that will fit in perfectly before purchasing.
Well, let's shift attention to the capital market, where we expect mixed performance. What are you seeing from where you are?
Well, on the capital market, we are still seeing increasing bid and increasing demand for stocks like MTN, Benso Oil Palm, and Total. We expect this to continue for some time. As we are speaking, MTN jumped a Pessoa. Benso Oil Palm also jumped by some Pessoas to close at about, I think, 12.83 so far. We expect this to continue once investors also are looking towards the banking stocks, the ones that are appearing to be underpriced, but also waiting for the first quarter performance before making some investment decisions.
All right, Patrick Edemagama, Head of Trading, Republic Securities. Nice haircut, good to see you. Enjoy the rest of the day. We'll speak about haircuts. Government is going to turn its attention to its external creditors to try to close a deal with respect to restructuring of Ghana's debts. You know, over the weekend, last Friday, in fact, the government was able to secure Parliament's approval to pass 3 tax measures crucial for securing an IMF deal. And so we move on to the next header. Joining us is Associate Professor of Finance at Andrews University, Williams Pipra, to discuss this some more. So quite a tough task for the government, but it was able to pull through with getting the MPs to pass the tax revenues. And so we are going to be discussing what next, but I want us to touch a bit on the implications for businesses and individuals, because we saw the business community come out to speak against these taxes. And what it essentially means for them is that life has become more expensive. Is that it?
Good afternoon, Daryl, and thank you for calling me. Yes, the assertion is very true. These new taxes, the three new taxes, which are made up of the income tax amendment bill, which was passed, the SI duty taxes, and growth and sustainability amendment bill. These taxes are known as indirect taxes, and it means that the producer or the supplier must factor them in their pricing and pass it on to their customers. Simply put, it's going to make their product or service that they offer very expensive. The implication, especially for the excise duty and growth sustainability taxes, will mean that Ghana as a whole in general is not going to be country with tax friendliness. Businesses, you will see that foreign direct investment is going to reduce. Earnings of companies are also going to reduce, and you also see that the Ghana Stock Exchange possibly will be the worst performer for 2023 because of these taxes. Already there are some policies by Bank of Ghana limiting banks to pay dividends to their shareholders, and we have seen the impact on the Ghana Stock Exchange being in negative in terms of returns. And when it comes to individuals, cost of living in general is going to go up because they will be bearing the cost of these taxes. From two angles, the income of individuals are going to be reduced, especially those in the high tax bracket of the pay as you earn, with the additional bracket of the 35% rate. So a lot of people are going to pay more in terms of taxes, and which will affect their purchasing power. And this is going to worsen the situation for the citizenry. And these are the implications. I understand that government aim is to make sure that they increase revenue to be able to cover the expenditure, and also be able to get IMF agree on their deals.
Well, so DDEP take tax measures take now. The government is going to have to focus its attention on its external creditors. How easy would it be to navigate that?
I mean, it's going to be very difficult. We already know the discussion going on with China. Already the Paris Club and other bilateral lenders to Ghana. Ghana may have to justify why this must be done. We know that the IMF is urging most of their members to consider granting some reduction or haircuts in their investment in Ghana. It's not going to be an easy tax for government, because for the external creditor to accept that I'm foregoing some of my interest income, and even some of them accepting a reduction in their principal payment, is very difficult at this moment. We should understand that anyone who grants us such access is also going to demand something in return, and that is what is going to happen. We may not just go and tell them, forgive us our debt, but then it means that we may have to also put something on the table so that they will benefit in future.
Well, I want to follow up on that, put something on the table so that they can also benefit. What would that be?
I mean, in the case of China, we know that they want access to our natural resources. So probably something like that may have to come at play. And some of them who also want to expand in terms of Ghana softening some, giving Ghana access to their, be able to import things from or send a lot of goods to Ghana in terms of trade. And we may have to be prepared to soften some of our trade stance to pave way for such discussions to happen.
The president of the World Bank is quoted to have told the BBC that he's concerned about some of the loans China has been making to developing countries in Africa. David Marper said the terms and conditions need to be more transparent. Is there any cause for concern dealing with the Chinese? Can we be confident that we'll have a really good outcome to all of these talks based on the finance ministers meeting with them?
In general, any country or any individual granting a loan or credit to any company or a country, apart from giving out the money, we also have some motive for providing that kind of support or finance. And we know that China wants to dominate Africa. They want access to our market. They also want to have an influence in the politics in Africa. And they also want to change the mindset of Africans towards Chinese in a positive way. So that is why possibly this caution is being given. It's been known that most of the times Chinese loans become a burden for African countries to pay because of the way they are structured. But if we also, as Africans, or Ghana, we also have our agenda, we'll be able to find a way to benefit from the Chinese agenda. We know it's very clear of the Chinese agenda in their report that they want access to Africa. They want Africa to accept them as a preferred and partner in terms of development. That is why they are pushing more money into infrastructure and also granting some loans to us. But in that return, they expect us to also open up our country to them, where they'll be able to, let me use the word, exploit our natural resources. If Africa, we are not prepared to go in that direction. It is left to us in Africa, especially, to also have our own agenda in how to deal with these external countries like Europe, USA, and the Asians. And if you look at Africa, we don't have an agenda. We just want money for possibly politics and rapid development. But we should also have an agenda. Whatever money we are taking, we should have a possible way of addressing these excesses that are coming. And we cannot say we will not take the Chinese money. Just that the caution is that we have to be concerned with and know the motive. And the motive of China is very clear. They want to have preference, or Africa should know them as the preferred destination. And once they have Africa joining them in terms of political ideology, in terms of market, by 2050, Africa will have the highest, in terms of numbers, our population is going to grow and we have the market. So China is preparing itself to be able to dominate and influence the youth, and that is what is currently happening.
All right, last question. We obviously missed our March deadline for an IMF program, and Fish Solutions last week in a report said that it was confident that we were going to secure the program in the second quarter. How confident are you in that as well?
I mean, that should have been government timeline from day one. We were all cautious about that 3 months timeline government set. And we know that we are almost done with the internal arrangement, left with government negotiation with the power producers in Ghana. Then the attention from now to June will be with the external creditors. We believe that the Paris Club negotiation will not be too difficult. We expect the Chinese to also grant us one of their 4 options that they have, especially giving us a short-term period in terms of possibly reprofiling our debt for between 3 to 5 years. And then now we'll also put the structure in place. The difficult parts will be the Eurobond holders, because their kind of negotiation will be very tough, and they hold majority of the external debt. So that attention possibly from now will be with the Eurobond holders. Already they understand the risks involved in holding the country's bond, but we must follow the due process in dealing with the parties involved in the Eurobond approach. That should be the government focus for now. Okay. How we will be able to convince the Eurobond holders to accept a possibly haircut on their investment in Ghana.
Thank you so much for your time with us this afternoon. Williams Repri, Associate Professor of Finance at the Andrews University. And that's the Marketplace. Thanks for watching, everyone. More news on our website, myjoyonline.com/business. We will be back same time tomorrow.